everyone, this is Ronica, tax advisor and CPA. I am super excited that you enjoyed the last real estate video and glad for the questions that came in. Well, this video, the question that I'm going to address, or the concern that a lot of business owners have when they start investing in real estate is, I thought that once I start investing in real estate, then I won't have any tax liability. Basically, once I start buying properties and investing in real estate, then I won't, be paying any taxes, or somewhere in between is normally the concern, because there's a lot online about real estate investing, and some of the things that you can benefit from. So when it comes to this question, there are three answers to it. Is this true? Is it false? Or it depends? And I think that you'll agree with me that it depends, right? It can be true for some people. It can also be false for others. So it normally depends, right? Because it's never a one-size-fit-all scenario when it comes to taxes or financial. So it depends. But I will tell you that it's extremely easy to get your real estate portfolio, your real estate business that you're going to form a business and operate your real estate that real estate business is extremely easy to get that down to zero, which will result in zero taxes. This means that you'll still have a profitable real estate business, and you will still be generating cash flow, but it doesn't mean that you're gonna have to pay any taxes, on the profit, just because of things like, depreciation. If you use a loan, then the loan interest and things like that, you'll get to write off. So, as I said, so that scenario is extremely possible to have your real estate business pay no taxes, and based on the volume and the type of real estate and things like that, right? So the next scenario I'm going to present is, and this is what most business owners may fall in, they have a profitable business. So for instance, they have a next S Corp or something that's netting $400,000 or $500,000. Let's use $500,000 for this example. And they're also investing in real estate. So one of their goals is to use their real estate investments to offset that $500,000 that their main business is making. So how do they accomplish this? In this case, this is a scenario that requires way more planning, just because of different factors. So the first thing that you're going to want to have in place is understanding, what's the volume of investment that you're going to need to have in order to create those write-offs that will be able to offset your $500,000 in your business income, right? And in most cases, one property is not going to do it unless you're probably in California or New York and it costs millions plus. Then that's quite possible for $500K. But in most cases, people in those markets, if they're buying a real estate of that size, then there are other businesses potentially making a lot more money than $500K. But I hope you get the point. So the volume of how much, write-offs you're going to have in your real estate. So, so one or two property may not do it. So this is when you have to come up with your real estate investment plan to see how, what's the return that you're going to be getting on your investment? How is it going to grow so that you can move towards that tax offset sooner than later? The second part of this puzzle is also, are you using leverage, and how much leverage you're using? Are you financing your real estate acquisition? Because this will also help for tax purposes as well. And the third thing is getting over the passive activity rules. So what I mean by getting over the passive activities rule is, when you become a real estate investor, by default, the IRS classifies this type of business investment as passive. And what that means is that you're not materially participating in this business. You're just a passive investor. You're buying, you're holding, you have a property manager and things like that. And that's how a lot of people want their real estate investment to be, to remain pretty passive, because they're running an already profitable business that they want to continue to run. So for instance, you're a doctor, engineer, or attorney, or a CPA. So normally in this case, just because those expenses won't be deductible because they're considered passive, they won't be deductible until you're able to generate also other passive income. And this is especially the area where the planning become extremely important, because we want you to be able to deduct those passive losses. So we have to help you to be able to have this passive income. So there are two ways to do it. One is if the business owner is able to be classified as real estate professional. This is extremely hard to do, and some people will and some people won't. So if you don't classify as a real estate professional, the second thing is that you have to find a PIG. And P.I.G, this is a passive income generator, not the one that we eat, right? Not that pig, but a passive income generator. So this is where you're going to use your main business to some way generate some passive income as well, so that you can write off the loss. So there's various ways on how you can create a PIG. There's a lot that's listed online. I've listed some as well in the blog article that's listed on my website about the 5 most powerful tax benefits from real estate investment. But that's the way you're going to go if you're stuck into that passive activity box that you're not able to write off those losses to offset your business income. If this passive loss thing is becoming a loss that you have to be carrying over year after year, and your provider is not able to find a solution to get you to deduct all of those write-offs from your real estate portfolio, then that's the time to go ahead and schedule a time with us so that we can help you to get all of those items completely written off. As I said, that there's several options. Go ahead and check out my blog article on this topic, and you'll see some of those options, and let me know if you have any questions.